We've been bullish on equities since April, and we've been beating that drum very aggressively. We don't think markets are complacent, and we think they'll end the year much higher than where they currently stand. We've been bullish on equities since April and have been beating the drum aggressively. We push back strongly on the view that equities are being complacent, and we think that markets will end the year meaningfully higher for a number of reasons. First, corporate earnings are solid, and we think they'll get better as we go into the back part of the year and into 2025. We think earnings will grow into valuations, and as a result, valuations will not be a constraint on further equity upside. Secondly, globally growth is slowing, but it's a long way from recessionary levels. Even though we've seen some disappointment and softening out of the US in terms of the labour market and activity data, it is a long way from recessionary levels. In addition, with the Fed joining the rate cut cycle in early September alongside the RBA in the next week, we think monetary conditions will continue to get easier as we go into the back part of the year and into 2025. And lastly, and most importantly, the mentality of buying the dip is alive and well. We think that's because a lot of investors are underweight equities, and within the equity allocations, they're not risk-loving enough. We think that this combination of factors will be strong tailwinds for equities as we go into the back part of the year, and enough to offset concerns around risks. We're positive as we look towards the profit season. We think that macro commentators are being overly pessimistic on the outlook because this will be the third year of negative growth, and because it's likely management will give very cautious guidance as we go into the second half of the year. It's very important that we calibrate the trends as we move into the profit season. First, it's very normal for earnings revision momentum to be negative and for guidance to be cautious. That is no different to what we've seen in the 3 years post-COVID. Second, at turning points, it's very normal for analysts to underestimate the profit recovery. Management tend to be cautious, and analysts don't want to be over their skis in terms of being overly optimistic. And lastly, the macro backdrop is improving. Cyclically, things look like they've bottomed, and the RBA is likely to provide a strong tailwind as we go into the back part of the year. All told, as long as we don't get a negative read from offshore markets, which is not what we think, and also the results are in line with expectations, we think that the market will look through the reporting season towards a much stronger outlook in the second half. We think downside risks are containable, and equity investors should remember that minor corrections are part and parcel of investing in risky assets. Historically, you've seen around 2-5% corrections in US equities each year. You've seen a 10% correction every 18 months. For Australia, deep corrections have been even rarer, but minor corrections have been more frequent. It's important to understand that these corrections are just normal parts of equity investing. Secondly, we think that the offsets to negative risks, such as an improving macro backdrop, easier monetary conditions, solid corporate profits, will more than offset the concerns around trade, economic growth, stagflation, and an other long list of concerns that investors have. When we think about the backdrop, we don't think that these risks are strong enough to actually offset the tailwinds that you're getting from improving macroeconomic conditions and very strong corporate fundamentals.